opening, well, I totally missed out on Monday market. So I was away, but I believe the estimate was 24.90 to, no, 24.60 to 23.90, and did open around there, 24.70. The reason that number came out was because was a consumer confidence, and it ran up too high, because I think we're in the part of the rallying mode, so it would just overreact on good news, positive news and stuff, and so it looked like it was going to just cool off a little bit on the day after. Okay, this wasn't it. Yeah, on this one, and then it rallied back. Totally missed this one. I wasn't able to trade this day, other than exiting some of the positions I had, one of which was the Walmart. So which comes to today, it seemed like they actually did better than I thought they would, so it ran really high, but I already closed my position, so I missed that. And same with the BBBY, Bed Bath. I left the position yesterday, but today was a squeeze. And well, those type of things can't be really explained. It just, the short squeeze just happens. But the thing is, it's anticipatory, so you could kind of see it coming. That's why I even opened the position like 2 days before, on Friday, I believe. I opened it around like $11 or $12 or something like that. You see the squeeze coming for that one, but I think it happened. So I think now it's on the coming down side. Back to the Walmart thing, I still believe that those retail and the wholesale, the stores like Walmart, Target, Costco, or even any shopping places where people spend money in, would do pretty well. I was actually initially thinking until the Q3, or whatever their fiscal year number is, the coming one. So I do have a position in CVS, but today I realized that the spread is really wide. The market maker spread on options, especially, it's really wide, and for many stocks that's not tech. And what that implies is that it implies a market inefficiency. The liquidity for stocks that's not tech is very low. That's why the spread is so big, so large. And what that implies is that it's right now the money is concentrated in one place, which is the tech. So that usually indicates that it's a bubble, and bubbles usually pop. And when it pops, it's going to crash pretty hard. And I mean, I know that's what everybody's saying, but I wasn't really believing in it. I usually just follow the price action, and even when it was crashing, when SPY was crashing, I actually thought that we would recover now, because the way the price was moving kind of indicated that the Wall Street doesn't really care about the rate hikes anymore. Because if the rate is hiking but earnings are great, then why would you sell? Because the point of buying stocks is for the anticipated earnings, and if the companies figured out a way to fight inflation in their own way and they're having a great revenue, why would you not buy? So the patterns were kind of ignoring the rate hikes for some time. So I was actually bullish when everyone was bearish with like around 370 or 380, and I just kept buying, and now we're at 430. And at this point, because looking at the spreads only at this point, I think there could be a crash coming, especially NASDAQ, like the QQQ. Let's look at QQQ. Yeah, because it's heavily concentrated in tech, I think it's going to collapse at one point. But the reason for that is not technical analysis, because a lot of people depend on like certain points that because it's hit the resistance here is going to collapse really hard. That makes no sense because technical analysis is based on historical data. These are all historical data. It's not. It happened because someone did something. It's not the other way around. This is not a leading indicator. This is lagging indicator. So to say that it's going to crash hard because it's nearing this point or that point, that's not a good way to think about it. But what I do think is actually the housing market crash can lead to the tech sell-off because it's heavily concentrated. And the reason for that is CDO, which is a collateralized debt obligation. And this is separating the mortgage-backed securities, and they put it into grades and classes. And as the rate hikes, the Fed fund rate hikes, the mortgage goes up, and then the interest rate goes up for the debt buyers. So a lot of people will be buying the debts as the mortgage is going higher, and what the Fed is selling their MBS as well. The problem with that is the banks, they insure it. The credit default swaps, they insure those debts so that if the debt defaults, then the bank pays for it. And because housing crash could be happening, I don't know much about the real estate, but it seems like that could be the case because the credit system might be kind of messed up. As previously, I don't know how it goes right now, but previously the credit ratio used to work like the more you borrow, higher credibility you have, which is kind of a nonsense. So eventually people can't pay for it, and it defaults, and that's how a crash starts. If that happens, banks have to pay to the investors. How are they going to pay for all that? They would have to liquidate some of the positions they have in stocks or in their investments, which right now is in tech because of this spread. You could clearly see that something that is not tech has a very, very high spread, which implies the market inefficiency between exchanges and sectors. So I do think that it will crash. And how far will it crash? Certainly a lot. It could come down a lot. I would say maybe 286, the QQQ. Yeah. And when would that happen? I'm not sure, but also I think it's safe to say after the next rate hike, which is in September. Probably there will be a rate hike in September. After that, more investors will be buying the debts because the rate is now higher, and that's when things could get a little bit funny. So I would actually buy a leap put on QQQ. Maybe like it could be far out in the money. I would say 287, 286. I think that's a possibility. For today's SPY run, well, for past couple days there was a pharma run, and today I think the run is partly the Inflation Reduction Act signing and partly minutes, anticipation to the minutes report tomorrow. So minutes report, FOMC announcement last month was actually positive because Jay Powell was mentioning the inflation is moderating, and it seemed like their tools were working. So even on minutes is basically kind of same thing as what happened during the meeting. So same, it's similar to the announcement. So I think the run was because of that. And then it kind of cooled off because it went to the max volatility. It went to the bell curve. Usually when it goes outside of the bell curve, it would kind of sink back in. And the way to get these number was, I talked about it. on previous videos, the implied volatility equation is the price at that time, times the implied volatility of the option at the money, times the trading days remaining until that option that has the implied volatility, divided by the square root of 365, and divide that by the trading days remaining, which was part of, I mean, I wrote it down on the other video. So yeah, so it went down, but for tomorrow I think it will actually open lower. I think a lot of people trades the chart first, then find out what happened later. That's why whenever there's minute or whenever there's an announcement, it fluctuates both ways very, very hard until it settles down into one direction. So tomorrow I'm definitely thinking there will be a liquidation before the FOMC. You know what? It could actually open very flat. So wherever this is right now, it could continue on until the open, which is 429, 430-ish. But I would say slightly lower, because even people will be selling up to the support one to the pivot point next day based on current price.